Hello, I'm Andy Agathangelo, and I'm very proud to be the founder of UK-based but very international campaign group called the Transparency Task Force. Our purpose is to promote reform of the financial sector so that it serves society better. We really do believe that the financial industry is profoundly important to the well-being of society, to political stability, and of course, economic stability too. But, but, we also believe it has a very high predisposition to misbehave if ever given the chance to. And the sad reality, of course, is that if you have lax or poorly drafted or poorly executed financial regulation, you are in effect inviting the sector to misbehave. It's a sector that, of course, has a very, very strong profit motive. And those profit motives can be so strong that they will encourage, entice, all but the very high integrity to maybe bend the rules or cut corners or put profit before principles or money before morals. Describe it any which way you like. But the bottom line is this: the behavior of the financial industry affects us all. It can affect us very, very positively, for example, through providing money in the event of a breadwinner's death, or through providing money to buy a first home or put kids through education or whatever it might be. But of course, it has also caused complete carnage in the past. When we think of the global financial crisis, not only did that cause meltdown around the world in the financial sense, it also caused various recessions, which led to, according to Oxford University, led to over 10,000 people taking their lives. So this is serious stuff. I really do want to impress upon you the seriousness of good and effective regulation. Of course, some countries are better at this than others. There are very few people that have a truly international perspective on this, but our key speaker today, Dr. Andy Shmulo, most certainly does. When he introduces himself, I hope you, Andy, will take time to explain to people how you've ended up with a pretty good understanding internationally of how different kinds of regulators operate. And then, of course, move on to the main topic for the conversation today, which is the question: can adoption of the Treating Customers Fairly framework improve consumer outcomes in Australia's financial industry? We'll try to make the conversation cozy amongst friends, as it were. Please feel free to use the chat to put comments and questions, ideas, links to anything you may want to link to, folks. Please also feel free to raise your hand to ask questions or make a comment. We'll try to make this as conversation as we can so that it is as enjoyable and hopefully as informative as possible. I mentioned earlier, I'm very proud to be the founder of Transparency Task Force. I really, really am. I'm also very proud that this is our second event where we are, as I like to put it, joining the hemispheres, having people from both the UK and Australia all together to cover a topic of interest to all of us. I do hope that sets the scene. Brace yourselves for what I think is going to be a very, very interesting and probably quite robust conversation about topics that really do matter. I'll now very, very gratefully pass over to Andy Shmulo, Dr. Andy Shmulo. Can we please show our appreciation to Andy just before we start talking? Thank you very much indeed, Andy, for being here, for preparing your session, and for the delivery you're about to start. Thank you very much, Andy. Thank you.
No appreciation necessary. It's my pleasure and my privilege. And a very good evening to listeners in Australia, and a very good morning to my friends in the United Kingdom. And as an homage to my friends in the United Kingdom, and in their honor, I'm wearing my
Dr. Who
TARDIS, my TARDIS cufflinks. Thank you very much, Andy. I've come to know Andy over the past, what would it be, Andy? 6 years? About 6 years. And I must say, there are few people who I feel as privileged to know and to work with as Andy Agathangelo. He is truly a purpose-led individual. He is an absolute thoroughgoing mensch. He's a force for good, and it is past time that he was acknowledged and recognized on His Majesty's Birthday's honours list. Thank you once again for attending. Let me start off with what I think is some useful context. There is an occupant in the White House today, a man who sits behind the Resolute desk, a man more capricious, more psychologically unsound, more pig ignorant, more untrustworthy, and possibly closer to certifiably insane than any other ever to sit behind the Resolute desk. And the chaos that he is causing has only just begun. Do you know where he began? He began with a promise to drain the swamp. And that built on a narrative that preceded that orange monkey. It built on a narrative about draining a swamp in reference to Wall Street. It built on a narrative that emerged after the global financial crisis, when people saw how Wall Street had destroyed the global economy, had brought the United States economy to its knees, had done so by gambling their institutions, and got away with it scot-free. And a narrative has taken hold all over the world that the game is rigged. And it is in that febrile environment that this, I don't know whether he's a borderline lunatic or brain damaged, this idiot is now sitting with his fingers on the nuclear deterrent. It is a frightening state of affairs. And so it cannot be underestimated the damage that it does, and the damage that it has already done to Western civilization, to our faith in Western civilization, to our faith in the cornerstones of Western civilization: democracy, individual liberty, and the rule of law, that misconduct in the financial industry perpetuates. It creates an irrefutable impression that the game is rigged. And part of what this organization, TTF, needs to do, and part of what you as members of TTF need to do, is you need to call this out. We need to call this out, and we need to oppose it, because it's rife. And in Australia, what we have seen is bewildering. Australia is a country notionally of the rule of law. Australians have a reputation for being law-abiding, rule-abiding citizens. You know, when I came to Australia in 1997, there were all sorts of small and minor ways in which obeying the rules was brought home to me, obeying the rules in a way that I wasn't used to doing in South Africa. And so an impression was created in my mind that Australia is a country of law-abiding citizens. And for the most part, we are. But our financial industry exhibits conduct that is some of the worst in the world. And my field is comparative, internationally comparative financial regulation. And so I am concerned and I am focused on instances of misconduct and the way in which that misconduct is combated in various parts of the world. And Australia is worse than Wall Street. In fact, before Russia invaded Ukraine, and I stress before Russia invaded Ukraine, I was contacted by a senior official at the Bank of Russia who had some questions for me, and I answered the questions as best I could, and I gave this fellow all the support and help that I could. And I stress this was before Russia invaded Ukraine. If I got a question from an official at the Bank of Russia today, obviously I would refuse to in any way collaborate with them. But this was before Russia invaded Ukraine. And this senior official at the Bank of Russia asked me to explain to him some of the findings of the Hayne Royal Commission, our banking misconduct in the banking and financial industry Royal Commission, as it pertains to insurance. And off the top of my head, I gave him some anecdotes. Charging life insurance premiums to customers that the insurer knew were dead. As Commissioner Haynes said, you were charging life insurance premiums where you knew there was no longer a life to insure. Charging life insurance premiums to the dead and then rewarding one another with bonuses and promotions. Instances where people who had death and disability insurance were denied death and disability cover despite the fact that they were rendered permanently disabled. One fellow was left a paraplegic, and ComInsure refused to pay out on his death and disability insurance. They said he wasn't permanently disabled. I'll give you another example. A woman who worked for ComInsure. ComInsure, for those of you in the United Kingdom, was a division of Commonwealth Bank. Commonwealth Bank is the biggest bank in Australia. Commonwealth Bank was fingered by the Royal Commission as the gold medalist for misconduct, a criminal enterprise, right? And I don't use those terms lightly. A criminal enterprise. If you were to analyze Commonwealth Bank's behavior against, for example, the provisions of the RICO Act, the Racketeer Influenced and Corrupt Organizations Act, which is the American legislation designed to combat, as they put it, racketeering, which is an old-fashioned way of saying mobster, mafia entities. The RICO Act has, if memory serves, something like 36 definitions of what constitutes running a racket. And if you breach more than 2 of those definitions, then you are liable to be deemed a criminal enterprise. By my estimation, Commonwealth Bank breached at least a dozen. This is the biggest bank in Australia, a taxpayer guaranteed, 4-pillar policy protected, systemically important, iconic Australian financial institution, which started out life as the Reserve Bank of Australia. Started out life as the Bank of Australia, as in the Bank of England, and was later private when the Reserve Bank of Australia had its commercial banking division privatised. The commercial banking division kept the name Commonwealth Bank of Australia, and what was hived off was called the Reserve Bank of Australia. So the Commonwealth Bank started out its life as our central bank. And by my estimation, they would have been liable in the United States to be deemed a criminal enterprise 6 times over. And the Hayne Royal Commission referred to them as the gold medalist for misconduct. One of their divisions, ComInsure, employed a woman who was diagnosed with multiple sclerosis. Now, for those of you who know what multiple sclerosis is, you will know that it is the most ghastly terminal illness. There's no cure. Its sufferers always die. But before they die, they descend into the most helpless, grim, sad life, bereft of any shred of dignity. It is a ghastly, debilitating disease. This woman was diagnosed with multiple sclerosis. She informed her employer Commonwealth Bank. They said to her, well, it's terrible news. Unfortunately, we have to discharge you because we deem you permanently disabled. We have to sack you on the basis that you're permanently disabled. So this is now the second double whammy, right? So she said to herself, well, it's even more terrible, but thank God, I've got disability insurance also with ComInsure. So having been told by Human Resources that she was to be permanently discharged on the basis that she was permanently disabled, she rang up the claims department and she said, I've been diagnosed with multiple sclerosis. I'd like to claim on my disability insurance. And they said, unfortunately, we don't regard that as a disability. So she said to them, there must be some mistake. I work for ComInsure. And they've discharged me on the basis that I'm permanently disabled. Oh, no, they said. Oh, no, that's Human Resources. We're claims. Monstrous, disgusting, indefensible, vile, subhuman cruelty. What happened to the people involved? They got bonuses. What happened to the CEO of the Commonwealth Bank Group? Got a $13 million bonus in his final year. Blood money. When I told this fellow from the Bank of Russia all of these stories, he said to me, my God, we don't even see this in Russia. Russia is a kleptocratic mafia state run by Russian bikie gangs and the Don of Dons, an awful, wicked, jumped-up little thug by the name of Vladimir Putin. And they don't even do that in Russia. This is the point that Australia has gotten to. It's despicable. So we had a Banking Royal Commission in 2018. I was the first Australian to support the call, first Australian academic to support the call for a Banking Royal Commission when it was first mooted in 2014. I supported that call longer and more consistently than any other academic. I had to go up against some luminaries, some academic luminaries in Australia, like Professor Kevin Davis, Professor of Economics at Melbourne University and a member of a number of very important and significant commissions of inquiry, probably Australia's foremost academic economist. He said that a Banking Royal Commission wasn't necessary. And it took a lot to go up against people like Kevin Davis. And I'm pleased to say, after the Royal Commission, Kevin Davis had the decency to say, not to me, but publicly at least, that he was wrong. What came out at our Royal Commission was an industry where the extent of misconduct was such that it would make Wall Street bankers blush. What came out at our Royal Commission was evidence of a regulator weak, feckless, and suborned. What came out at our Royal Commission was a legislative framework that is, it's difficult to know how to describe it. A runaway train? No, I couldn't describe it as a runaway train because at least a runaway train makes some progress in terms of covering distance. A runaway train on a circular track, maybe. A corporate regulator that is in my opinion, the worst in the Western world. Absolutely hopeless. And that's not just my opinion. That was the opinion, that was the outcome of the assessment done of our corporate regulator by the 2014 Senate inquiry, by the 2014 Financial System Inquiry, by the 2015 Treasury Capability Review, 2018 Hayne Royal Commission, and by the 2024 Bragg Inquiry. 5 for 5. 5 for 5. 5 inquiries, 5 assessments. This regulator doesn't work. And part of the reason they don't work is because they've got the wrong leadership. But in fairness, part of the reason they don't work is because the law is unenforceable. And I want to give you some insights into that, and then I'm going to tell you about the research project that I'm doing. Our legal framework by which we enforce conduct in the financial industry is covered across something like 7 different pieces of legislation. There's the Insurance Act, there's the Superannuation Industry Supervision Act, there's the Banking Act, there's the National Consumer Credit Protection Act, there's the Australian Securities and Investments Commission Act, and there's the Corporations Act. This is the Corporations Act. This piece of legislation is 3,000 pages long. Add to this piece of legislation the other pieces of legislation that I mentioned, and the legislation covering financial services in this country runs to about 5,000 pages. It is longer than the entire Codex of Norwegian law, so I'm given to understand. On top of the 5,000 pages of legislation, there's a further 43,000 pages of regulations. And according to Commissioner Hayne, Royal Commissioner Hayne, who chaired the Banking Royal Commission, he's a former High Court judge. The High Court is Australia's highest court of appeal. According to Commissioner Hayne, none of it works. It's extremely difficult to define. It's extremely difficult to know what the sections mean without litigating them. And where do you begin and where do you end? It's extremely difficult to enforce. It's extremely difficult to find the right sections. There's no overarching table of contents. There's no overarching table of definitions. The definitions change in various parts of the legislation. The legislation is hyperlinked. Tens of thousands of hyperlinks, hundreds of thousands of hyperlinks, referring to other sections and other pieces of legislation and other bits of regulation. And some of those hyperlinks then link to other hyperlinks, which link to other hyperlinks, which link to other hyperlinks, which link to places that are no longer valid. So how's that for a rabbit hole? It's a catastrophe. It is a legislative catastrophe. In fact, if I were to meet Franz Kafka in an afterlife, I would say to him, you know, Mr. Kafka, I think you're wildly overrated. Not because you don't write well, you write beautifully. Your problem, Mr. Kafka, is you lack imagination. These dystopian horror worlds that you create are thin gruel. You want to see a horror show? Come with me to Australia. I'll show you our financial services legislation. That'll leave you twitching in a corner. In Wingecarribee Shire Council and Lehman Brothers, Mr. Justice Rearies had to decide on which sections were applicable in the ASIC Act versus the Corporations Act. So what our drafters have done in an act of, I don't know whether it's an act of lunacy or whether they were being purposely mischievous and wicked, is they have drafted almost, and I stress almost, and I'll come back to that, almost identical provisions, almost identical but not identical, almost identical provisions in the ASIC Act and the Corporations Act. So guess what? If you have two provisions that say almost exactly the same thing, but not exactly the same thing, then it forces the court to look at those two sections and define them differently, even though the purpose of that section might be to cover exactly the same conduct. So if instead of using the word shall, you use the word will or ought to or must, or you use the term disclosure of a product instead of product disclosure, it can be as prosaic and irrelevant as that. If you draft two sections that are almost identical but not identical, then the court has to bring down a different definition for the one versus the other. This is not only a waste of the court's time, as Mr. Justice Rearies put it, trying to sift through the legislative porridge, but it also means that you can have a situation where, in order to have two distinct definitions of what is essentially the same section, you have to define them so narrowly that the conduct that you're trying to combat falls between the two of them and escapes punishment. How's that for a perverse outcome? And if you don't believe me, let me give you an example. Give you an example of absurd construction and absurd interpretation. In the case of ASIC versus Westpac, one of our big four banks, ASIC took Westpac to court and said to the judge, Justice Perham, ASIC is breaking the law because they're not complying with the legislation. The legislation says that when Westpac grants a loan, when they give somebody a loan, they must determine whether the loan is affordable. They must determine whether the customer can repay the loan. Fair enough, right? In order to determine whether the customer can repay the loan, the bank must look at the customer's income and the customer's expenditure. Now, for those of you who have an accounting background, this is really not rocket surgery. Can you afford to repay the repayments on the loan? I don't know. What's their income? What's their expenditure? How much is left over? That's how much money they've got to repay a loan. Easy stuff, right? So ASIC said, Westpac is calling for information about income, but they're not using information about expenditure. Oh no, said Westpac, yes, we are. We call for information about income and we call for information about expenditure. So ASIC said, yes, but you don't use the information that you call on to calculate the loan affordability. You call for information about expenditure, but you don't use that in the loan calculation. Correct, said Westpac, we don't. Well, how can that be sensible, said ASIC. Oh, said Westpac, the legislation requires that we call for information about expenditure, but once we've called for it, the legislation doesn't say we have to actually use it. This is the point at which I feel like I need to take a run up to facepalm. What's the point of calling for the information if you're not going to use it? Well, the answer is because the law says we have to. Okay, well, if you're going to call for the information, then why didn't you use it for the loan calculation? Because the law doesn't say we have to. Well, why did you call for it then? Because the law says we have to. This is the absurdity on stilts that we face with Australia's legislative framework. If you want to know if a customer can afford the repayments on the loan, then this is what you have to do. What is their income? What is their expenditure? Minus the expenditure from the income, this is how much the customer has left over every month. Is that enough to service the loan? If the answer is yes, then you can grant the loan. If the answer is no, then you mustn't grant the loan. What good does it do not to use the information on expenditure? Well, I'll tell you what good it does. It suited Westpac because instead of using the information about expenditure that they got from the customer, they used a fictitious benchmark. They used a fictitious bunch of made-up numbers about expenditure. A fictitious bunch of made-up numbers set so low that if you actually complied with that benchmark, you would be marginally above the breadline. And that suits Westpac because it sets expenditure very low, which means they can afford, the customer can notionally afford a bigger loan, so Westpac can lend more money and make more profit and drive more people into a debt trap. And Mr. Justice Perham, in his judgment, and I make no criticism of his honour, no doubt his honour's interpretation of the legislation was correct. After all, his honour was upheld 2-1 on appeal. But in making a finding about the use of this fictitious benchmark, Mr. Justice Perham said, oh, well, you know, maybe the customer eats Wagyu beef and drinks Shiraz 3 nights a week. Maybe they can do without that. Maybe the benchmark doesn't allow for eating Wagyu beef and drinking Shiraz 3 nights a week. So, well, there's some validity to that, except, of course, Australians have the lowest rate of mortgage default in the world. Australians will go without meals before they default on their mortgage. And there is evidence reported in the ABC of mortgage holders seeking emergency food aid at soup kitchens in Adelaide. So the reality is, it's not that people skip Wagyu beef and Shiraz, Mr. Justice Perham. The reality is people skip meals. And people who skip meals are over-indebted. They're in a debt trap. And that's exactly what the legislation was meant to prevent. So these are the absurdities that we face. So partly out of great frustration, and partly because it's my job as an associate professor in the law school at Wollongong University, that's just a plug for my employer, satisfy my overlords in Mordor, I applied for a Australian Research Council grant. I must admit I've been applying for this grant for eight or 9 years. I've been trying to get one for 8 or 9 years, and by some miracle managed to get one at the end of last year. They are extremely difficult to get, these grants. They are only university academics in Australia are able to apply for them. It's an incredibly onerous and time-consuming process that the application itself would probably be the equivalent of a master's degree. And of all of the people who apply for them across every faculty and every university, about 91% of them fail, and about 9% of them succeed. And I'm reliably informed by my colleague at Sydney University, Professor Jason Harris, that they are, for all intents and purposes, impossible to get in law. And somehow we managed to get one. They're impossible to get in law because the assessors and the College of Experts, I think, have difficulty understanding how lawyers can do research. If it isn't being done with test tubes in a laboratory, then how is it research? So we managed to get a research grant to investigate the Treating Customers Fairly regime. The Treating Customers Fairly regime, TCF, was implemented in the United Kingdom in 2005 and copied into South Africa in 2011, and was going to be instituted in New Zealand this year. I'm not sure whether that'll happen. They've elected a very neoliberal government in New Zealand, and it appears that that neoliberal government is putting treating customers fairly on the back burner. Now, for my dear friends in the United Kingdom, of which there are many on this call, no doubt many of you will be saying, well, we're not sure that's such a good idea. We've had treating customers fairly for a long time in the United Kingdom, and things are by no means perfect in the UK, and I hear you. TCF has certainly had mixed results in the United Kingdom, but I think that there's also evidence that it has facilitated some improvements. But I tell you where TCF has fallen down in the United Kingdom, not because it's a deficient regime, but because it's been poorly implemented and confused. The Treating Customers Fairly regime is a principles-based approach to regulation, and there is some misperceptions about that. There are a lot of people in the United Kingdom who think that the principles-based approach to legislation and regulation of the financial industry has failed. That's not true. It's not that a principles-based approach has failed. It wasn't a principles-based approach before the global financial crisis. It was a light touch approach. And a light touch approach and a principles-based approach are not the same thing. A light touch approach is a recipe for disaster. And a principles-based approach and the TCF approach absolutely requires and envisages enforcement. And enforcement requires punishment. When firms disobey the law, when firms breach the law, when firms don't treat customers fairly, it is absolutely necessary for the maintenance of the framework that they be punished. And there hasn't been enough of that in the United Kingdom. There's been very little of that in the United Kingdom, especially with firms at the big end of town. The Financial Conduct Authority and its predecessor, the Financial Services Authority, have been, to put it mildly, suboptimal in their enforcement. Not as bad as ASIC, of course. No one's as bad as ASIC. But certainly they have been suboptimal. So how can I be so confident that TCF does in fact offer a panacea? And the answer is that it is going absolutely gangbusters in South Africa. It is achieving extraordinary results in South Africa. And this is a very curious state of affairs, because South Africa is not exactly a paragon of the rule of law. I mean, let's face it, it is a country that is riven with corruption. It is a country that is sliding towards the status of being a banana republic. Corruption in government is out of control. So why is it that the regulation of the financial industry is working out so well? And I'll tell you why it is. First reason, South Africa has a population of about, I think about 60 million people. Of those 60 million, 90% are black, 10% are white. The 10% who are white own 90% of the financial industry, and the 90% who are black own 10% of the financial industry. And the country is governed by a political party that started out its life as a black liberation movement. So the financial industry in South Africa has no cachet with government. They have no entree to government. They have no influence over government. They don't snap their fingers and government doesn't say, "How high, sir?" The financial industry in South Africa is on the back foot. And the financial industry and the people who run the financial industry know, and they know only too well, that if they commit misconduct, and they do so at scale, 90% of the victims will be black South Africans. And not just that. South Africa has an unemployment rate of about 30%. South Africa has an unemployment rate that is of the highest in the world and very little social security. So of the 90% of victims who will be black South Africans, probably 30% of them will be vulnerable or extremely vulnerable consumers. White-owned financial industry firms in South Africa know that if they go down that route, that will be the quickest, fastest, most hassle-free route to being nationalized. So they're frightened. And I got to tell you, a frightened banker is a productive member of society. It's that simple. If these guys are not fearful, they get out of control. You know the old adage, fire is a good servant but a bad master. Bankers are good servants, but they are bad masters. A frightened banker is a beautiful thing. They are productive members of society, and so they are terrified of misconduct. And so they obey what the regulator tells them to do, and they don't argue back. But on top of that, the regulator is under pressure from government. Under pressure from government, all regulators are under pressure from government. FCA, ASIC, SEC, they're all under pressure from government. But they're all under pressure from government to forbear. They're all under pressure from government to go easy on enforcing the regulations, except in South Africa. In South Africa, the regulator is under pressure to put heads on sticks. So they don't put up with any crap. And they conduct themselves in a manner that is intrusive, proactive, and preemptive. When they see bad things happening, they're straight in there and they say to the regulated population, "Not satisfied with this. Don't like this, fix it immediately." And the regulated population doesn't argue back. Let me give you an example. I had a number of meetings with people at the South African regulator. They're called the FSCA, the Financial Sector Conduct Authority. And I said to them, regulated entities, are they respectful towards you? I'm a great believer that regulated entities need to treat the regulator with respect, right? Unfortunately, with ASIC and the FCA, it's very difficult to make that argument because they're not regulators that command respect. But if the regulator's doing a good job and trying their best, as far as I'm concerned, the regulated population must be obedient. Do as you're told, right? And I said to the members of the FSCA, so do the regulated entities, they treat you with respect? Yeah, we think they do. So I said, give me an example. And I got this example on several occasions. There are different ways to calculate and advertise the interest rates that you will pay, right? So if you've got a bank account, if you're advertising a bank account in the newspapers, there are different ways that you can advertise how much interest that bank account will pay. There are different ways of calculating the interest. In Australia, we have one way of doing it. It's called the effective interest rate. I'm not exactly sure how the calculation works, but there's general consensus in Australia. This is the only way you should advertise the interest rate. So the FSCA went to, this is a conversation that they had with two of the six major banks, two of those six, and one of the minors. So three banks in all, they had this conversation. They said to the bank in question, we're not happy with the way you advertise the interest rates. And the bank said, okay, the legislation that enables the legislation that will allow you to dictate to us how to calculate those interest rates. The legislation is called the Conduct of Financial Institutions Act. Hasn't been passed yet. It's still in bill form. I've had the opportunity to contribute to its drafting. The regulated entity said to the regulator, that piece of legislation hasn't been passed yet. And so because it hasn't been passed yet, you don't yet have the authority to tell us how to calculate the interest rates. To which the regulator's response was, yet. It hasn't been passed yet. It will be passed. And when it is passed, if you haven't done what we told you to do, we'll be straight back round here to do a deep dive, an intrusive, preemptive, and proactive dive into every aspect of your business. Because if you don't follow our instructions, what it says to us is, you've got a bad attitude. And if you've got a bad attitude, then you've got a bad culture. And one of the aspects of our remit is we got to come after any firm that has a bad culture. So thanks for saying no. You're top of our list. And I said to them, and what was the response? And they said to me, the response was, terribly, terribly sorry. How would you like us to calculate the interest rates? Not so hard, is it? Dealing with bankers is like dealing with children. I know you're not allowed to say this anymore, but, you know, I grew up in a world where tell a child to do something several times, don't touch the pot on the stove, and the child doesn't listen, you give it a smack. Now, I know we're not allowed to say that anymore. We're not allowed to smack children anymore. God, no. That's probably why children today are so brattish. But anyway, world I grew up in, you got a smack. Didn't kill me. It didn't make me a dysfunctional human being. In fact, what it did was convince me not to touch pots on the stove and pour boiling water over my head. Same with a banker. Child, banker, same thing. Every now and again, a good hard smack. It's the only way they listen. This nonsense about leave it up to them and industry self-regulation, for God's sake, what nonsense. So let's have a look at what the treating customers fairly regime means. It rests on 6 core principles, which I've pulled up on your screen. These are the 6 core principles of the treating customers fairly regime. You can see that they are almost identical in South Africa versus Australia. Wording is almost identical. I prefer the South African version because it's a little bit more pithy. See if I can highlight it for you. Maybe is that a bit easier to read if I make it bigger? How's that?
We can read it. We can read it fine as it was, Andy. That's even better. Thank you.
Now, at the conclusion of the Hayne Royal Commission, the Banking Royal Commission, What I'm about to say is very difficult for me to say. Excuse me for a moment. Very difficult for me to say this. Doesn't come naturally to me. Commissioner Hayne, former High Court judge, highest appeal court in Australia. Commissioner Hayne, Justice Hayne, is much smarter than I will ever be. He's much more accomplished than I will ever be. He's a legal titan and a jurisprudential colossus. I will never be any of those things. And I hold Commissioner Hayne, Kenneth Hayne, AC, KC, not just in the highest respect, but in awe. And so it's difficult for me to say what I'm about to say. But I don't think Commissioner Hayne, I don't think Mr. Justice Hayne really understood well, if at all, regulatory theory. I'm a regulatory theorist. I deal with regulatory theory. And I don't think that Commissioner Hayne understood regulatory theory well. That might be because he's a judge and he's a black letter law lawyer and he's used to only reading law cases and legislation. But Commissioner Hayne said at the end of the Royal Commission, he said, there's all this stuff about principles-based regulation, which is what the Treating Customers Fairly regime is, by the way. And these are the Treating Customer Fairly 6 core principles. These are the 6 core principles. Commissioner Hayne said, I don't know what all this stuff is about. What we need, he said, what we need is we need norms of behavior. 6, funny thing that, 6 core norms of behavior. And the 6 core norms of behavior that we need, said Commissioner Hayne, are let's see if I can find them now. Just hold on a moment. These are the 6 norms of behavior. What's the difference? What's the difference between these 6 norms of behavior, these 6 principles of conduct? Same thing, isn't it? In fact, these 6 principles of conduct are more extensive than Commissioner Hayne's 6 norms of behavior. So when I make the argument that this is what Australia needs, these are not just the rantings of a madman. This is what Commissioner Haynes said. He just didn't realize he was saying it. What's the difference between his 6 norms of behavior and the 6 principles of the Treating Customers Fairly regime? And if the Treating Customers Fairly regime has been implemented very successfully in South Africa and with limited mixed success in the United Kingdom, where that mixed success is mixed due to poor implementation, well then, isn't the answer, if our legislative regime, this runaway train that isn't even making any progress in terms of distance, this is just a runaway train on a circular track, this Kafkaesque nightmare, if this isn't working, then maybe the solution is the Treating Customers Fairly regime that's well implemented, which means that to have it well implemented, the first thing we'd have to do is scrap ASIC. And not only that, because it's principles-based, because it enlivens principles of conduct, as opposed to a black letter law, granular, incessantly and inanely and ridiculously and absurdly detailed approach to everything. You can have legislation that's much easier to read and to understand. Let me show you what I mean. This is the South African legislation on product disclosure. Now, ladies and gentlemen, product disclosure is very, very boring, but very, very important. It's important that customers be informed of the risks that they are assuming when they take on a product. And there's no point in informing customers with a 40-page legal document. Nobody's going to read that, and if they did, they wouldn't understand it. You need to inform customers in a way that they will understand what it is that they're reading. Here's the South African legislation. It goes from the top of the left-hand page, where it says disclosure, up to the red bar. It's 1.5 pages long. Can you read it, by the way?
Yes, we can.
Now let me show you the Australian equivalent to that 1.5 pages. Let me show you what great and wonderful things our legislation has achieved. This is the Australian equivalent of those 1.5 pages. Are you ready?
And
You'd
that's
hope
just product disclosure, Andy. Is that was just on product disclosure, Andy? Is that what you're saying?
just product disclosure.
Right. Choose. Thank you.
You would hope the geniuses who wrote that legislation were paid by the word. They would have achieved intergenerational wealth. And not only can compliance officers not understand all of that, let alone remember it all, but what likelihood is there that members of the public can read that legislation and understand their rights? Whereas, I would very respectfully suggest it's very easy to read and understand. Before, during, and after the conclusion of a contract for the provision of a financial product or financial service, a financial institution must make a financial customer aware of all relevant facts that could reasonably be expected to influence the customer's decision relating to that financial product or service, including benefits and risks, costs, contractual obligations, consequences for each party of breach, and recourse options. Now, viciously stung by that exercise in legislative absurdity, the geniuses in our Treasury decided to simplify those 61 pages of product disclosure legislation with the following amendment. And they thought they were terrifically clever because they reduced all of it to just that, patting themselves on the back. Personally, I don't think they're that clever. They've used the word reasonable 6 times. If you want things to be reasonable, then you make the use of the word reasonable applicable to the entire section. When you make the word when you use the word reasonable 6 times, guess what happens? Guess how it gets interpreted? The reasonableness only applies to the sub-paragraph in which it appears. So subparagraph 1 says a reasonable person, but subparagraph 2 doesn't say reasonable, so it doesn't have to be reasonable in respect of a professional advisor. Absurd. Fail. Do not pass go. Do not collect your pension check. So I had a look at this section and I thought to myself, I wonder if it's possible to rewrite that section in a manner that is straightforward, uses plain English, isn't confusing, doesn't use the word reasonable in an absurd fashion, and is intelligible to the lay public. Moreover, and I'll leave you to have a look at what I've said there. Now, my take on 1125 might not be perfect, but it did take me less than 5 minutes to draft. I mean, it's really not that hard. And on top of that, let me point out to you this nonsense on the left, this idiotic, asinine nonsense. About a professional advisor is completely superfluous. What you want is that the disclosure must be intelligible to the customer. If it's intelligible to the customer, it will, by definition, also be intelligible to their professional advisor. So it's irrelevant whether the customer is supported by their financial advisor, their pet psychologist, or their mum. And it seems to me that our drafters just can't get their head around the notion less is more. And I think that's where I'm going to stop. I've spoken far too long. I've rabbited on. I haven't obeyed the rules about how long I should speak.
It's been great, Andy. It's been really great. We've all been. I've been sat here listening to every word you've spoken. You've delivered such a clear and compelling message about the urgent need for change in Australia, much of which, by the way, applies to the UK as well. But you've also pointed out to us, and this is so helpful, you've also pointed out to us how the treating customers fairly regime in South Africa is working, and you've provided us with the context to understand why it is working. Andy, as you know, you often cause me to think and to visit thoughts and ideas that I probably would never have got to on my own. And I really welcome your your input to the Transparency Task Force and the work we've done together over the years. It's been fantastic. Um,
Great pleasure.
during your conversation with us, you've caused me to think about a few principles. Something you said to me and others, maybe about 2 years ago, I think it was, when we were working on the APPG's report on the Financial Conduct Authority and looking at recommendations. You used a phrase that I now probably think about at least once a week because it captures so much wisdom in just a few words. And the phrase is, people are policy.
Yep.
And I would love you to please bring that phrase to life because I think it explains so brilliantly how, you know what? Yes, of course, the rules and regulations matter, the wording matters, all of that stuff really does matter. But if the people in charge of actually making it actually work in the real world are for some reason not incentivized to make it work or have conflicts of interest or there are revolving door problems or they've got multiple friendships and alliances with people they're regulating, which makes it awkward for them to not pull their punches, and all those sorts of things. It explains why the treating customers fairly regime in the UK hasn't worked. It explains why the evolution of that in the UK, which is the consumer duty, isn't working. And frankly, anything else that gets produced, which relies upon the right kind of people with the right kind of mindset and motivations, making it happen, isn't going to work either. Can you please tell us about people are policy, Andy? Thank you.
You know, culture. Have you ever heard the expression culture eats strategy for breakfast?
Yes, indeed. Yes, indeed.
Culture is everything. Culture is how we do things around here. Culture is our values. It's how we make decisions. It's what matters to us. Culture is everything. Culture is everything. And the reason we don't take it seriously enough, and the reason we don't take it more seriously, is because we can't plot culture on a graph. And we have this obsession with quantifying everything. We've got to quantify it. Where does it sit on the graph? And how do we measure it? If you can't measure it, it doesn't exist. I've got news for you. There are lots of things you can't measure, but they exist. Love. Is love not the most powerful force in the universe? And how do we measure love? There are lots of things that can't be measured, and it doesn't mean they don't exist. But to the mind of an economist, to the mind of someone that deals with quantifying everything, it's in the too hard basket, so they ignore it. And I've had this conversation with economists. I had a fascinating, I was collaborating on a piece of research with 3 other economists. I love working with economists. I love the language of economics. I love the discipline of economics. I love the thinking behind economics. But, you know, really take everything economists say with a pinch of salt. Economics gives the impression of being a natural science. It's not. It's a social science. And they try and make it look very sciencey by reducing everything to equations. There are some things that you can reduce to a mathematical equation. There's a lot of stuff that you can't. So I've had this conversation with economists. Culture. Culture is the way in which a financial service provider will behave. Culture is the way in which a financial service provider will assume or avoid risk. Culture is the way in which a financial service provider will or will not bet the firm. Culture is the way in which a financial service provider will bet the bank like it's a gambling institution or a casino. Culture is the way in which a financial service provider will treat its customers. Culture is the way in which a financial service provider will treat vulnerable customers. And let me remind you, we are all vulnerable at one stage or another of our lives. And I've said to these economists, the economists that I was working with, but you can't plot culture on a graph, which is why it's often ignored. But this is where and how it affects the behavior of a firm. And I must have said to these guys 3 or 4 times, you can't plot it on a graph. And then I explained at length how culture affects everything the firm does, how culture affects the way a firm interprets the law, right? The interpretation of the law is not black and white. The interpretation of the law leaves room for interpretation. And how you interpret the law comes back to your culture. And one of these guys said to me, one of these economists said to me, God, this is fascinating. I wonder how we could put it on a graph. I kid you not. Culture in a financial institution or culture in a regulator is the values that are espoused by that institution, and the values that are espoused by that institution is very often a reflection of the values espoused by individuals. Individuals who are purpose-led, individuals who believe that right is better than wrong, individuals who believe that justice is better than injustice, individuals who are concerned for the welfare of their fellow man or woman or their children, individuals who want to make the world a better place don't do well and don't survive and don't last in institutions like Goldman Sachs, because they feel alienated and they feel ignored and they feel that the purpose and the values of the institution doesn't reflect their own. Institutions that employ people who are workplace psychopaths, and there's research that has been done that I'm vaguely aware of that says that there are more psychopaths in charge as chairs and chief executives of major corporations than there are in jail. Right? And not all psychopaths become serial killers and cannibals. Some of them do, but some of them say to themselves, well, I don't need to be a serial killer and a cannibal because eventually I'll get caught and sent to jail. But I can do just about anything else as the chair or chief executive of a company and get away with it. Well, why don't I rather do that? So psychopaths gather around them people who share and reflect their values, which in the case of a financial institution that's led by the wrong person is to collect around yourself people who have no values. What did Hector Sanz once say? He said, principles-based legislation is of no good when you're dealing with people who have no principles. Which is wrong, by the way. It's perfectly acceptable to use a principles-based approach with people who have no principles, as long as you're ready to punish them. If you don't punish them, then it doesn't work. Darren, I do see your hand up. I'll stop talking in a moment. I will come to your question in a moment. If you, in the conversations that I had with major financial institutions in South Africa, I had a conversation with the chief executive of one of South Africa's big 6 banks. I won't say which bank, but he said to me, my greatest fear is that I get to work one morning and 60 Minutes is doing a story in the foyer. What would be the UK equivalent of 60 Minutes?
Panorama or something like that.
Panorama. I get to work one morning and Panorama's in the foyer doing a story. He didn't say to me, my greatest fear is a sudden explosion of bad debts. Or my greatest fear is a sudden massive increase in interest rates. Or my greatest fear is an exogenous economic shock. Or my greatest fear is some dreadful scandal in the trading desk and we've, like Barings Bank, lost hundreds of millions of dollars. He said to me, my greatest fear is I get to work one morning and Panorama is in the foyer doing a story. In other words, there's a reputation scandal. There's a conduct scandal. There's a scandal in which we've engaged in misconduct, because if we've engaged in misconduct in South Africa, remember 90% of the victims are going to be Black South Africans. And then, next stop, destination nationalisation. And if that happens, Mr. Chief Executive will be out of a job before the close of business that day. So guess what happens when he employs people? He has a choice of two candidates. One candidate, his name's John, has no morality, and he's dynamite at making profit. But there's a risk he's going to bring scandal on the firm. The second candidate, Jane, she's got some morality. She won't make quite as much profit, but it's much less likely she's going to bring scandal on the firm. Which one do you think he's going to employ? In South Africa, he's going to employ Jane. And who's Jane going to employ? Other people like Jane, because that's natural human bias. So you get this filtration all the way from the top, tone from the top. There's an Afrikaans expression, soort soek soort, birds of a feather. Birds of a feather flock together. You get people who are value driven. You get people who don't think dishonesty is funny. You get people who don't think it's funny to make as much money as possible, and it doesn't matter how many customers you screw over. You get people who are values driven, who are honest, who are ethical. They seek and collect and aggregate around themselves other people like that. And the corollary is also true. People who are psychopaths, people who will make money at any cost, people who will screw their customers, people who will damage other people's lives and care nothing about it, will collect other people who reflect those values because, hey, boys, money, money, money. So if you get the right people, they bring in more of the right people. And where this was enlivened in our discussion, Andy and I, where this was enlivened is a discussion that I had with Professor Patricia McCoy. Professor McCoy is the Liberty Mutual Professor of Insurance Law at Boston University. And she was one of the creators of the US Consumer Financial Protection Bureau, a wonderful Obama administration initiative. And she was the foundation deputy chair for mortgage protection. She was the foundation deputy chair for mortgages in a bureau that was established after the mortgage crisis. So that's how important she is. And she said, in the creation of the CFPB, I said to her, how did you create an organization that works so well? How did you create an organization that has such courage, that it has even stood up to the orange monkey? And she said to me, by getting the right people. People are policy. Darren's had his hand up for a long time.
Andy, before we go to Darren, this has been just absolutely fascinating. I'm literally going to watch the recording of this. I've been listening to every word you've spoken. Every sentence has opened up a whole line of thought. Fantastic stuff, Andy. Mr. Darren McShane, lovely, lovely, sir, to have you with us. Down under, please do share your thought, Darren. Lovely to have you with us. Thank you.
Thank you to both Andys. Thank you, Professor. It was an interesting presentation. It raised 1,000 questions, which we don't have time for in the 8 minutes remaining. But I want to talk just a little bit practically about TCF and how you see that. What are you suggesting practically that look like in Australia? Because to me, we've been around this loop of outcome-based regulation versus blackout regulation at least 3 times in my working life. They're not going to repeal that 20,000 pages worth of regulations and ASIC's guidance and law, and you couldn't put an overlay over the top of that with a whole series of different tests. I'm just wondering practically how you think that would look.
With very great respect, I must query where and when we went round the loop of outcomes-based legislation. There have certainly been times when the regulator has claimed to do that. But
Yeah,
to
I'll give
my
you a practical example. Yeah. The disclosure one you referred to, at various times, I was at ASIC, so I drafted some of this stuff. At one stage, we went right back to the basic principle, give consumers information reasonably necessary to make a decision. Didn't work because everyone did everything differently. Courts wouldn't interpret it in the way we wanted to interpret it. So then you had to have rules about it. So that's then when you get back to the rules. Politicians then came in and said, we need more regulation. So you then build up the simplified disclosure regime, which is another 1,000 pages. Then they don't do the fee stuff properly. Someone's got to say how they. So it builds. And there's certainly been periods, I'm thinking back to the late 90s, when the government's directive was we only want outcome-based regulation. So they were going to cut away a lot of the chaff. Didn't work terribly well. And they, soon as anyone got into trouble, after the GFC, they wanted more rules. Everyone then wants more rules. So you go through these loops repeatedly, I think, in relation to the financial services regulation.
So the simplified disclosure, give people the stuff that they reasonably need, and everybody came up with something different. That is contemplated by TCF. You can be different. The question is whether that difference is a reasonable enlivenment of what you're trying to achieve. And if it's not, then the duty falls on the regulator to explain to the regulated entities why they are not compliant. But what it does not mean is to fall back every time there's a hit, to fall back into old patterns. Granular black letter law does not work in the financial industry because the financial industry innovates too quickly. It is a fool's errand. And it also requires the regulator to have the temerity to say to regulated entities that demand ever more granularity, to say to them, no, we're not giving you more information. And there's a reason why they keep asking for more information, because they want to shift the risk. They want to shift the risk of interpretation from themselves back to the regulator. And what ASIC has not done, what ASIC has been bad at doing, is saying to regulated entities, the answer is no. We are not giving you everything you want. And Sean Hughes said to me that one of the problems that ASIC has had is that the regulated population keeps demanding more and more granularity and more certainty and more risk transplacement from themselves to the regulator and more detail. And they keep getting more and more detail. And then they turn around and they say, the regulations are too long. They're too long and it's impossible for us to comply with this because they're too long. That's the route you go down when you don't embrace this liberating word, no. And the South African regulator is very good at saying no. And so when South African entities come to the South African regulator and they say, we need more, the South African regulator is very good at going, you've got enough information, learn to cope. And the South African entities that I have interviewed have said to me, it's extraordinary, right? It's extraordinary. In the interviews that I've conducted with them, they've all gone through the same process, what I call the equivalent to the 7 stages of grief. Denial, bargaining, fear, acceptance. They all go through this process of a principles-based approach is too vague. We don't know how to do this. We can't do this. It's impossible. It's impossible what you're asking us to do. My God, this is unreasonable. Well, we better try and do something just to show them that we've tried to do something, but it's all unreasonable and it can't be done, but we'll try and do something. We've tried to do something. Actually, this is quite interesting. We're taking on this process and we're finding we can actually do this. And we're finding it quite liberating. And we're finding it very interesting. And we're gaining confidence. And we're gaining confidence in our ability to interpret what is in our customers' best interests. And we do it. There are ways in which we develop to do it. I call one way the Nana test. If you want to know, if you're confronted with a piece of regulation that says give your customers adequate product disclosure, I think that the answer to that's very easy, right? Imagine this product is being marketed at your grandmother. What would you want to ensure takes place so that your beloved grandmother is not taken advantage of? And whatever your answer, there's your answer. It's the nano test, right? There is plenty of evidence from the South African experience that it is possible to provide regulated entities with a high-level degree of principles. And I must tell you, Darren, not only a high-level degree of principles. Let me just point out to you. Actually, let me point it out before I go looking for this document. The principles-based regime absolutely contemplates broad principles supplemented where necessary by rules. But this is the balancing act. This is the part where the regulatory craft comes in. The supplemental rules must not become a vast tome of black letter law, because then you've destroyed the principles-based approach. Please just give me...
While you're finding that, Andy, if I may just chip in on this particular point. A few years ago in the UK, Parliament asked the Financial Conduct Authority to consult on with the intention of introducing a duty of care with a legally enforceable private right action. And it's our understanding that if that had happened, it would have taken perhaps a few paragraphs to explain what this legally enforceable private right of action was. And it would have basically been an overarching rule number one, if I can put it in such simplistic terms. And what it would basically have said it was, if any entity that's regulated does something that causes foreseeable harm, then it has done wrong and it can be litigated against. And that was the idea of the duty of care for all kinds of reasons we haven't got time to go into right now. The FCA didn't introduce that duty of care. It introduced the consumer duty, which is a bit like treating customers fairly, but a far more complicated version of it that the industry is pushing back on because it's so hard to implement. We ended up with loads and loads of pages, I think 350 odd pages of consumer duty language and rules, instead of what would have been a few paragraphs. And we understand that the reason the FCA didn't introduce a duty of care is because the industry didn't want it, because it would have been so easy for them to be held accountable. If you do something that's wrong, that's likely to cause foreseeable harm, then you're on the hook. Full stop.
Right.
That's back to you, Andy. Thank you.
Darren, this is so important. The issues that you've raised are so important. I don't want to skip over this because I feel like if I was talking to ASIC and they said to me, it's all hopeless, we've tried this before, it didn't work, the first thing I would say to them is I would say, that is not correct. This can work, it does work, and it's worked elsewhere. You've got to change the way you make it work. But let's understand a few things. You cannot regulate the financial industry with granular black letter law. It's impossible. It's failed everywhere in the world because the financial industry regulates too quickly. A lot of that innovation is faux. Some of it's real, robo-advice and AI, but most of it's faux. And the fact of the matter is, because financial products and financial services are ideational, because they are conceptual, because they are intangible, because they only exist in our minds, as many ways as you can explain a financial product or service, so there are as many ways that you can define a product or service. So the moment you seek to regulate financial products or services using definitions, you've lost. And that's why our legislation just gets longer and longer and longer, and the regulator gets further and further behind. It requires high-level principles, and it requires the ability to say, the high-level principle is this. Who is your customer? Put yourself in the position of your customer. What do they need to know about this product? Then put it to the regulator. Have they done that? And the first time they fail, you explain to them. Second time they fail, you say, okay, boys, we've told you you're not doing this right. You're facing down the barrel of a bad outcome. If there's a bad outcome, after we told you you're not doing it right, we're going to smack you hard.
I'd love to discuss this more with you offline sometime, but I can't agree with that because there's a cultural problem that you haven't identified, and that is the courts will not enforce general duties in Australia. They may in South Africa. UK, they're a little more inclined to. Having been there in Australia, you will not get a judge to come on the right side of a decision about a general duty.
Can I make a comment about that? You are absolutely correct that our courts, it's just pushing the proverbial upper hill to try and get our courts, and ASIC and Westpac is an example, to try and get our courts to enliven a principles-based approach, but they do it with the Competition Act.
Yes.
And so here's my question to you. If we had at the start of a piece of legislation like the National Credit, NCCP, the National Consumer Credit Protection Act, if you had a section that said, dear judge, every time you interpret a section in this legislation, you shall interpret it to enliven the overall principle of this legislation, which is to protect consumers from becoming over-indebted. Lots of love, Parliament.
That would basically be saying, that would be the system saying, we really want this to happen and we are going to enable what we want to happen to be enforceable and for it to work. And that is clearly what is necessary, because if you have one part of the system that doesn't really want things to happen, that another part of the system wants to happen, it doesn't happen. You know, you end up with the courts letting down the regulations. I get your point, Andy, entirely. We have a few minutes left, Andy. Please comment on that particular piece, and we'll invite anyone that's itching to come in with something before we wrap up to do so. Thanks, Andy. Back to you.
Well, while somebody's itching to come in, let me say this to you, Darren. I'm very critical of ASIC, but nobody was rooting harder for ASIC in ASIC versus Westpac. I was devastated when they lost. And I thought when it goes to appeal, surely saner heads are going to prevail. Like, as youths in hoodies would say, WTF, man. You've got to collect the information, but then you can throw it in the bin. Are you for real? Perham was upheld 2-1 on appeal. I just thought to myself, my God, this is insanity. Like, why is the legislation there? It's to stop over-indebtedness. We passed the damn thing in the aftermath of the global financial crisis, right? We passed that legislation because of what we saw happening in the subprime industry. Has the world gone mad? I said to Sean Hughes, please, God, you've got to take this on appeal to the High Court. He said, we're not going to do it. We're getting lashed by James Paterson in the Senate, who's saying, James Paterson, who must be the stupidest individual ever to sit in Parliament, said to ASIC, the Royal Commission said, why not litigate? It didn't say, why not appeal? Those were his words. Why not litigate, not why not appeal? I mean, that child is as thick as a fence post. And because ASIC was getting whacked by Paterson, who was saying, you shouldn't be appealing, you're wasting taxpayers' money appealing, and appealing isn't the same as litigating. He's just criminally stupid. ASIC was frightened about taking it to the High Court, and I said to Sean Hughes, you can't let this go, man. I look at what Perham said, and I look at the fact that Perham was upheld 2-1 on appeal, and I say to myself, there has got to be a way to draft legislation where you hold a stick over the bench and you say to them, we're not asking you. This is Parliament's prerogative. We are telling you. You will interpret the legislation to enliven principles. these are the principles you will enliven.
Wow. Wow. Andy, this has been just absolutely fantastic. I've really enjoyed every moment of this. We have to get you back, Andy. Yourself and Darren and others like you who have a great perspective on these issues. We need to have you back. This is our, as I said in the introduction, folks, this is our second Joining the Hemispheres event. It certainly won't be the last. We'll organise another one in 2 or 3 months' time. Does anybody have anything they are itching to say before we bring the conversation to a close and I ask Andy for his final thoughts? Please raise your hand digitally. Hannah, I can see you, Hannah. Please be as succinct as you can because we're running over a little bit, and share your thoughts, Hannah. Lovely to have you with us, Hannah. Thank you.
Hello. Thank you. I was just going to say that principles-based regulation certainly has not worked with lawyers in England and Wales and the Solicitors Regulation Authority, which they've advocated, and yeah, I shouldn't say never, but they rarely are held to those principles by the regulator.
You've opened up another huge can of worms. We haven't got time to go there, but thank you for doing so. Thank you for doing so. Does anybody else have anything they'd like to say? Anyone itching to say something? Mr. Nigel Cairns. Nigel, I see your hand. Please take yourself on mute. And the very succinct version, please, Andy. Thank you.
Nigel, yeah. No, I'm conscious I shouldn't be at the meeting. I've been admitted early because I'm in the next one. But very interested to hear Andy's comments, because obviously the exact same situation exists with regulatory failure in the UK, because as I've put in the chat, the courts aren't correctly following due process. And until that's sorted out, nothing is ever going to be resolved. Reviewable reasons are required to adhere to due process. They're not being given by courts anywhere because of the power of the multinationals in massaging or basically corrupting the legal system. And that's the sad position that I think is the case.
Thank you very much indeed, Nigel. I think you make a great point, sir. Thank you. We're going to go back to Dr. Andy Schmulo for his final thoughts before I then wrap up the meeting. Andy, back to you.
They're so happy that I'm going to stop talking. They've got fireworks going off. I don't know if you saw.
No,
we have them here. We have them here every night at 20 to 9, Sydney. You know. Look, Nigel, I hear what you're saying. I don't have time. There isn't time left because I've gone on too long. My fault. I'd love to discuss this with you at a different time, but maybe what I can say is for colleagues in Australia who've taken time out of their family time, from the bottom of my heart, thank you. For colleagues in the United Kingdom who've taken time out of their day, so grateful. Thank you so much. It's been a pleasure and a privilege to talk to you. Thank you so much for your time.
We'll have you back as soon as we can, Andy. Thank you very much indeed, Dr. Andy Schmulo. Please show our appreciation, folks. That was absolutely first class, sir. Thank you very much, and good luck with everything you're doing down under, Andy. And let's find a way to learn more about what the folks in South Africa are doing and who's leading the charge there. Thanks, Andy. Thank you all. Thank you very much indeed. Cheers.